Dan Ives believes trillions of dollars will be spent in the AI arms race, and in a recent CNBC interview, he explained why something much bigger is happening behind the headlines. The Wedbush tech analyst discussed the growing tensions between Anthropic and the US government, the global battle for AI dominance, and why the success of SpaceX could be a major catalyst for tech and AI stocks going forward. He also believes many investors could end up regretting the decisions they're making right now. First, I'll play you the interview clip. Then, I'll give you my detailed breakdown and reaction to everything Dan Ives said. And finally, we'll take a deep dive into 2 AI memory stocks that could be worth buying now. Let's hear what Dan Ives has to say.
Look, I think this is essentially a UFC battle between Anthropic and DoD US government. I think that, look, that's a slippery slope here that we're seeing with tech and government. And I think for Anthropic, it's trying to find for them a happy medium, because it ultimately is taking steps back relative to what's happened with OpenAI and broader, the AI industry. And that's part of the problem. It's always been the concern, Anthropic, with this sort of battle with the Pentagon.
And Dan, in terms of this big debate that we're seeing in Europe over tech sovereignty, is this accelerating the push towards that? I mean, this has been a key issue in Europe, given that they are relying on what is just a handful of big tech American companies right now.
Look, the reality right now, it's a 2-horse race between US and China. And look, it's a true 4th industrial revolution that's playing on. And when it comes to sovereignty and what we're seeing, look, this is just going to continue to accelerate relative from a technology perspective as we go into 2nd, 3rd, 4th derivatives, semi, space, infrastructure, energy. And in this arms race, it's trillions of dollars that's going to be spent. And when you look where Europe is, look, they're in a very, sort of almost a quagmire situation, because given data privacy, but then on the other hand, the innovation entrepreneurship that wants to happen, we're seeing that in France, Poland in particular, in terms of spots that are, peaking out in terms of AI leaders. But then you have US and China on the other side. So that right now, I think that would be a conversation in G7 as well.
And Dan, we'll get to G7 in a moment, but what are the implications currently now for European businesses who are relying on these models for Anthropic, and what is it going to do, I guess, for their supply chains right now? How much of a big risk is this?
Yeah, it almost puts a stop sign in front of it. And I think that is the trickiness here, because look, Claude, when it comes to Anthropic, is the best model in the world, and there's not even a question about it. So these restrictions that you saw with Claude, that's why Anthropic's meeting with Trump administration yesterday in DC, and I'm sure this week, because the implications there. Now, look, for what's a European business, could they switch off of it and go to another model? Yeah, but the reality is these models are built on Claude, and you can't keep having these stop-go situations relative to what's happened with Anthropic and DC. And that's always been our concern about the ripple effect in terms of this Anthropic DoD battle.
And Dan, as you mentioned quite rightly, these big CEOs, Anthropic, OpenAI, Google, Mistral, they're all going to be attending this G7 summit. What is going to be the key agenda from their point of view? I mean, particularly in light of what we're seeing with Anthropic at the moment and those US government security controls.
Look, there's a lot of things up in the air, but also there's a big focus on Europe, because everyone's trying to figure out what's the path there when it comes to AI. You're seeing green shoots relative to what's happened in France in terms of the technology side. But Anthropic, OpenAI, they also want to make sure that they get opportunities when it comes to Europe in terms of that continent. Because when it comes to AI, this is just the start of the 4th industrial revolution. Relative to physical AI, robotics, everything where we're going with NVIDIA. And I think that's going to be a conversation. You talk about sovereignty and some of the sort of I think trickiness or balancing between countries relative to technology. That's going to be front and center at G7.
And Dan, in terms of SpaceX, of course, that's been so much a focus for the markets as well. I mean, ahead of the IPO, many investors were concerned that this was going to maybe suck some of the oxygen out of that tech and AI trade. Given what we've seen with the IPO, the historic success that we've seen. I mean, how are you feeling about it now? Do you think we're going to need more time to see what this is going to mean for the likes of Anthropic and OpenAI coming to the market? And how are you feeling about the valuation story right now?
Yeah, I think you nailed it with that quite because think about the narrative the last month. The bears, they came out of hibernation mode, right? And they were yelling fire in a crowded theater saying this is going to suck the oxygen out of the tech trade. A lot of nervousness that we saw over the last few weeks in terms of chip stocks. But just given, I almost view it as a Goldilocks outcome relative to what we saw in terms of SpaceX, but importantly relative to tech. Because this is going to be a bright green light to own back, I think, into not throughout just the summer, but into year end. I think it's another leg up higher. I think we continue to see numbers go up much more relative to chips, software, infrastructure. And it's a positive for Anthropic and OpenAI because when this happens, that's a bright green light for them as well. Get the popcorn out.
One of the first things that stood out to me was Dan's characterization of the conflict between Anthropic and the U.S. Department of Defense. He described it almost like a UFC fight, and while that's obviously colorful language, the underlying point is serious. We are now entering an era where AI companies are no longer operating solely as private technology businesses. These companies are becoming strategic assets. Governments increasingly view advanced AI as something tied directly to national security, economic competitiveness, military readiness, and geopolitical influence. Dan suggests that Anthropic is trying to find a middle ground. On one side, there is pressure from governments that want access, oversight, and cooperation. On the other side, there are concerns about independence, ethics, and maintaining trust among customers around the world. According to Dan, this balancing act has always been one of the major challenges facing Anthropic. Personally, I think this is one of the biggest stories in technology that many investors are still underestimating. Most people focus on AI as a software story or a stock market story, but increasingly, AI is becoming a geopolitical story. The companies building the most powerful models are finding themselves pulled into national policy discussions, whether they want to be or not. That creates opportunities, but it also creates risks. As the conversation shifted toward Europe, Dan made a point that has become a recurring theme in many technology discussions over the last few years. In his view, the AI race is essentially a two-horse race between the United States and China. That is a bold statement, but it's difficult to ignore the evidence. The largest AI investments, the biggest data centers, the most advanced chips, and many of the leading AI companies are concentrated in those two countries. While Europe has world-class universities, talented engineers, and strong industrial capabilities, it has struggled to produce AI champions on the same scale as America or China. Dan framed this as part of what he calls the fourth industrial revolution. This is not simply about chatbots or image generation. He sees AI spreading into semiconductors, infrastructure, energy, robotics, automation, manufacturing, and even space technology. In other words, AI becomes the foundation layer underneath countless industries. That's an important distinction because many investors still think AI is mostly about software subscriptions. Dan's view is much broader. He believes trillions of dollars will eventually be invested across multiple sectors as companies and governments race to build the infrastructure necessary for an AI-driven future. What I found particularly interesting was his discussion about Europe's position. Dan describes Europe as being caught in a difficult spot. On one hand, there is a strong emphasis on data privacy, regulation, and consumer protection. On the other hand, there is a desire to foster innovation, entrepreneurship, and technological leadership. This tension has existed for years. Europe often leads the world in regulation, while the United States tends to lead in innovation and commercialization. The challenge is finding a balance that protects citizens without slowing innovation so much that competitors gain a permanent advantage. Dan did point out that there are encouraging signs. He specifically mentioned countries like France and Poland as emerging areas of AI innovation. These countries are attracting investment, talent, and startup activity. However, he still views Europe as being significantly behind the United States and China in the broader AI race. My own take is that Europe still has opportunities, but time is becoming a factor. Technology leadership compounds. The companies that attract the most talent, collect the most data, and generate the most cash flow often strengthen their positions over time. That makes catching up increasingly difficult. One of the more practical issues discussed in the interview involved European businesses that rely on Anthropic's models. Dan believes the uncertainty surrounding government restrictions creates a significant challenge. He uses the image of a stop sign appearing in front of businesses. Companies want predictability. If an enterprise builds products, workflows, or services around a particular AI model, they need confidence that those tools will remain available and stable. Dan argues that Anthropic's Claude model currently sits at the top of the AI landscape. In his view, there is no debate about its quality, because so many businesses have built around Claude. Sudden restrictions or policy changes create operational headaches. Could companies switch to another model? Technically, yes. But Dan's point is that switching isn't always simple. Businesses invest time, money, training, integrations, and workflows into these systems. Moving from one model ecosystem to another can be disruptive and expensive. This is something investors should pay close attention to because AI adoption isn't just about having the best model. Reliability matters, availability matters, trust matters. The companies that can consistently deliver all three may ultimately have an advantage even if their technology is only marginally better than competitors. The discussion then moved toward the upcoming G7 summit, where many of the biggest AI leaders are expected to participate. Dan believes AI will be one of the dominant themes of those conversations. What's fascinating here is that AI has evolved from a technology topic into a political and economic topic. A few years ago, AI conferences were mostly attended by researchers and engineers. Today, world leaders, central bankers, CEOs, military officials, and policymakers are all deeply involved in the discussion. Dan expects conversations around sovereignty, regulation, investment, and international cooperation to be front and center. He also highlights Europe's importance. While America and China dominate headlines, Europe remains one of the world's largest economic regions. Every major AI company wants access to European customers, businesses, and governments. That creates a delicate balancing act. European policymakers want technological independence. American technology companies want market access. Governments want security. Businesses want innovation. Investors want growth. Trying to satisfy all of those objectives simultaneously is incredibly difficult. Another major theme from the interview was Dan's broader vision of where AI is heading. He repeatedly referenced physical AI, robotics, infrastructure, and NVIDIA's role in powering the ecosystem. This is where Dan's long-term bullishness becomes very clear. He is not viewing AI as a single product cycle. He is viewing it as a multi-decade transformation. When he talks about physical AI, he's referring to machines that can perceive, reason, and interact with the physical world. Think autonomous robots, advanced manufacturing systems, intelligent logistics networks, and smart industrial equipment. If AI truly expands into these areas, the economic impact could be significantly larger than what we're currently seeing. Personally, I think this is one of the most exciting aspects of the AI story. Right now, much of the public discussion revolves around chatbots and productivity tools. Those applications are important, but they may represent only the first chapter. The real disruption could occur when AI starts transforming industries that involve physical labor, transportation, logistics, healthcare, and manufacturing. The final section of the interview shifted towards SpaceX and what its success means for technology stocks more broadly. This was arguably the most bullish part of Dan's entire discussion. Over the last several weeks, some investors worried that SpaceX's enormous valuation and market attention might pull money away from other technology opportunities. The concern was that investors would sell AI stocks, chip stocks, or software companies to chase the excitement surrounding SpaceX. Dan completely rejects that thesis. In fact, he argues the opposite. He describes the outcome as a Goldilocks scenario, not too hot, not too cold. Just right. According to Dan, SpaceX's success demonstrates that investors still have a strong appetite for transformational technology stories. Rather than draining capital from the sector, he believes it reinforces confidence across the broader technology landscape. This is why he says the result is effectively a bright green light for technology stocks. He expects continued strength not only through the summer but into the end of the year. He sees further upside in semiconductors, software, infrastructure companies, and the broader AI ecosystem. What's particularly noteworthy is that he also views this as positive for private AI leaders like Anthropic and OpenAI. If investors reward innovation at the scale demonstrated by SpaceX, it strengthens the investment case for other companies building foundational technologies. That is ultimately the core takeaway from Dan Ives's interview. Yes, there are regulatory battles. Yes, there are sovereignty concerns. Yes, there are geopolitical tensions. But despite all those challenges, Dan remains firmly focused on the bigger picture. He believes we are still in the very early stages of a technological revolution that will reshape industries across the global economy. He sees AI expanding beyond software into infrastructure, robotics, energy, semiconductors, and space. He sees trillions of dollars being invested over the coming years, and he believes the recent success stories emerging from the technology sector are not warning signs of a peak, but rather evidence that the next phase of growth may only be beginning. Whether you agree with his level of optimism or not, one thing is clear. Dan Ives is viewing today's AI developments through a much larger lens than most investors. He is not looking at the next quarter, he is looking at the next decade, and in his view, the race for AI dominance is only just getting started. Now let me show you two AI memory stocks that are positioned to benefit from one of the biggest technology spending booms in history. The first AI memory stock to buy now is SanDisk Corporation, ticker symbol SNDK. When most investors think about artificial intelligence, they immediately focus on graphics processors, AI chips, and the companies building the models. But there is an important piece of the AI puzzle that often gets overlooked: storage. Without storage, AI simply doesn't work. Every AI model requires enormous amounts of information to be collected, stored, processed, updated, and accessed. The larger the model becomes, the more data it consumes, the more users interact with AI systems, the more data gets generated, and as businesses deploy AI across their operations, the amount of information that must be stored continues growing at an astonishing rate. That is where SanDisk comes into the picture. SanDisk has become one of the strongest performers in the memory and storage sector, benefiting from a powerful recovery in the NAND flash memory market. For those unfamiliar with NAND flash technology, this is the memory technology used in solid-state drives, enterprise storage systems, cloud infrastructure, and countless devices that require fast access to data. In the AI era, speed matters. When organizations are training large language models or running complex inference workloads, they need storage solutions capable of delivering enormous amounts of data quickly and efficiently. This is creating a significant tailwind for companies like SanDisk. One of the biggest reasons investors should pay attention to SanDisk is that the company is directly exposed to growing demand from enterprise data centers. The AI revolution is causing hyperscalers, cloud providers, and large enterprises to spend billions of dollars expanding their infrastructure. Every new AI deployment requires storage. Every new AI model requires storage. Every new data center requires storage. As a result, SanDisk is seeing remarkable growth in some of its most important business segments. One statistic that immediately stands out is the company's data center revenue growth. During the third quarter of fiscal 2026, SanDisk's data center revenues soared by an incredible 645% year over year. Think about that for a moment. 645% growth. Numbers like that are extremely rare, especially for companies operating at this scale. That kind of growth tells us something important. It tells us that AI infrastructure spending is not theoretical. It is happening right now. Major customers are deploying capital today. Data centers are being built today. Storage systems are being purchased today. SanDisk is already seeing the financial impact. And this growth isn't happening in isolation. The broader NAND flash memory market has also undergone a dramatic turnaround. Over the last several years, memory markets experienced significant volatility. Excess inventory, weakening demand, and pricing pressures created challenging conditions for many storage companies. But now the situation has changed. The industry has become much more disciplined regarding production levels. Manufacturers have reduced oversupply, inventory levels have normalized, and pricing has improved significantly. This matters because memory companies often operate in cyclical markets. When supply exceeds demand, prices fall. When supply becomes constrained while demand increases, prices rise. Right now, SanDisk appears to be benefiting from exactly that environment. Demand is strengthening while industry production discipline is helping maintain healthier pricing. This combination creates a powerful earnings catalyst. Investors often underestimate how quickly profitability can improve when pricing conditions become favorable in memory markets. A small improvement in pricing can have an outsized impact on earnings. A larger pricing recovery can completely transform a company's financial performance, and that's exactly what appears to be happening with SanDisk. Looking at the company's recent financial results, the turnaround has been remarkable. During the third quarter of fiscal 2026, revenue increased by 251% year over year. Let me repeat that. Revenue grew 251%. That means the company generated more than 3 times the revenue it produced during the same period the previous year. Growth at that level is extraordinary, but the earnings story may be even more impressive. During the same quarter, SanDisk reported non-GAAP earnings per share of $23.41. Just 1 year earlier, the company reported a non-GAAP loss of 30 cents per share. That's not merely growth, that's a complete transformation in profitability. When investors search for turnaround stories, this is the type of financial improvement they hope to find. A business that moves from losses to substantial profitability often attracts significant investor attention because it demonstrates improving operational leverage, stronger demand, and better pricing power. What's also encouraging is that analysts remain optimistic about the company's future performance. Current expectations suggest fiscal 2026 revenue could increase approximately 164% year-over-year. Meanwhile, earnings per share are expected to surge roughly 2,097%. Those numbers are staggering. Now investors should always remember that analyst estimates can change and future performance is never guaranteed. However, these projections provide a useful glimpse into how dramatically Wall Street expects the company's financial profile to improve. Even more importantly, earnings estimates have recently been revised higher. In many cases, upward revisions can serve as a positive indicator because they suggest analysts are becoming more confident about a company's future prospects rather than less confident. But beyond the impressive financial metrics, I think the most important question investors should ask is this: why should SanDisk still matter 5 or 10 years from now? Because long-term investing is not about buying stocks with great quarters. It's about buying businesses that remain relevant long after today's headlines disappear. In my opinion, SanDisk's long-term relevance comes down to one simple idea. Data is becoming one of the world's most valuable resources. Artificial intelligence doesn't eliminate the need for storage, it increases it. Every year, more information is created than the year before. Every year, organizations store more digital assets. Every year, AI systems consume larger datasets, and every year, businesses become more dependent on fast, reliable storage infrastructure. SanDisk sits directly in the middle of that trend. The company's specialization in NAND technology gives it exposure to one of the most important components of modern data infrastructure. As cloud computing expands, enterprise workloads increase, and AI adoption accelerates, demand for flash storage solutions could continue growing for many years. Another aspect I find attractive is that storage tends to be less flashy than other areas of technology. That may sound strange, but it can actually be an advantage. When investors become overly focused on the newest AI software company or the latest AI model, they sometimes overlook the businesses providing the foundational infrastructure that makes everything possible. History has shown repeatedly that infrastructure providers often benefit enormously from major technological shifts. The companies supplying critical components can sometimes become just as important as the companies creating the end products. SanDisk may not always dominate financial headlines, but it plays an essential role in enabling the digital economy. And when you combine that strategic importance with rapidly improving fundamentals, accelerating demand, stronger pricing, and growing AI adoption, you begin to understand why many investors are paying closer attention to this stock. Of course, no investment comes without risks. Memory markets can be cyclical, pricing can fluctuate, technology evolves quickly, competition remains intense. Those are realities every investor should acknowledge. But if AI spending continues expanding at the pace many experts expect, the demand environment for high-performance storage solutions could remain favorable for years. And if that happens, SanDisk appears well-positioned to participate in that growth. At the end of the day, what makes SanDisk compelling isn't just one quarter of strong results, it's the combination of improving industry conditions, rising demand for NAND storage, expanding AI infrastructure spending, and the company's growing role in supporting the world's data economy. For investors looking for exposure to the storage side of the AI revolution, SanDisk is certainly a stock worth keeping on the watch list. If this resonates with you, you're exactly who this channel is for. Please hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. The second AI memory stock to buy now is Seagate Technology Holdings plc, ticker symbol STX. If SanDisk represents one side of the AI storage story, Seagate represents another equally important side that many investors completely overlook. When people hear the phrase artificial intelligence, they often picture cutting-edge chips, massive data centers, and advanced software models. But there is one question that rarely gets discussed. Where does all the data actually go? Every AI model requires enormous datasets for training. Every AI application generates new information. Every user interaction creates additional data that must be stored, managed, and accessed. The AI revolution is creating a data explosion unlike anything we've seen before. And while fast flash memory is critical for certain workloads, there is another layer of infrastructure that remains absolutely essential: large-scale data storage. This is where Seagate comes into the picture. Seagate is one of the world's leading providers of high-capacity hard disk drives, commonly known as HDDs. Now, I know what some people may be thinking. Hard drives? Aren't those old technology? That assumption is exactly why many investors underestimate companies like Seagate. The reality is that modern hyperscale data centers still rely heavily on high-capacity hard drives because they provide one of the most cost-effective ways to store enormous amounts of information. As AI adoption accelerates, companies are not just processing more data, they are storing more data than ever before. Training large language models requires massive data sets. Running AI applications generates constant streams of information. Organizations need places to store years of historical records, customer information, logs, backups, images, videos, and machine-generated data. The amount of information being created globally continues to rise at a staggering pace. That trend directly benefits Seagate. One of the strongest aspects of Seagate's business is its exposure to hyperscale cloud providers. These are the massive organizations operating some of the world's largest data centers. Their infrastructure supports countless applications used by businesses and consumers every day. As these organizations expand their AI capabilities, they also need more storage capacity. That creates growing demand for Seagate's nearline storage products. Nearline drives may not generate the same excitement as AI processors, but they serve an essential function within modern data infrastructure. Without large-scale storage, AI systems cannot efficiently manage the enormous datasets they depend on. In many ways, storage serves as the foundation beneath the AI ecosystem. The more data that exists, the more valuable storage becomes. The more AI grows, the more storage is required. This creates a powerful long-term demand driver for Seagate. What makes this opportunity particularly interesting is that AI workloads are not shrinking, they are expanding. Models are becoming larger. Data requirements are increasing. Organizations are collecting more information than ever before. As a result, storage capacity requirements continue climbing. Seagate has recognized this trend and continues investing heavily in advanced drive technologies designed to increase storage density and improve efficiency. That may sound technical, but the concept is straightforward. The more information a company can store on a single drive, the more attractive that product becomes to customers looking to maximize storage while controlling costs. This focus on innovation helps strengthen Seagate's competitive position. The company isn't simply selling storage products, it is helping customers solve one of the most important challenges of the AI era. How do you store exponentially growing amounts of information efficiently? That's a problem that is unlikely to disappear anytime soon. And when companies solve persistent problems, they often create durable business opportunities. What I find particularly compelling about Seagate is that it benefits from a trend that extends well beyond artificial intelligence. AI may be accelerating data creation, but the broader digital economy has been producing more and more information for decades. Every video uploaded, every online transaction, every cloud application, every connected device, every sensor, every database, every piece of digital content contributes to the growing need for storage. AI simply adds rocket fuel to an already powerful trend. As investors, one of the things we should always look for is businesses positioned at the intersection of multiple growth drivers. Seagate appears to fit that description. It benefits from cloud computing, it benefits from digital transformation, it benefits from enterprise technology spending, and now it benefits from the rapid expansion of artificial intelligence. When multiple growth trends converge on a single company, the opportunity can become very interesting. The financial results help illustrate that momentum. During the third quarter of fiscal 2026, Seagate's revenue increased by 44% compared to the same quarter a year earlier. That's a strong growth rate for a company operating at Seagate's scale. But revenue growth alone doesn't tell the full story. The earnings performance was even more impressive. Non-GAAP earnings per share surged 116% year over year. Think about what that means. The company's earnings grew more than twice as fast as its revenue. That's often a sign that improving industry conditions and operational leverage are helping profitability accelerate. When companies can grow earnings faster than revenue, investors typically pay close attention. It suggests management is not only generating more sales, but also converting a larger portion of those sales into profits. Another encouraging development involves analyst expectations. Current projections indicate fiscal 2026 revenue could increase approximately 32% year over year. Meanwhile, earnings per share are expected to climb roughly 84%. Again, these are projections rather than guarantees, but they demonstrate the level of confidence many analysts currently have regarding Seagate's business trajectory. There is another detail worth paying attention to. Earnings estimates have recently moved higher. When analysts revise earnings expectations upward, it often reflects growing optimism about future demand, pricing conditions, or business performance. That trend can sometimes serve as an additional positive signal for investors evaluating a company. Beyond the numbers, though, let's talk about competitive advantages. One of Seagate's biggest strengths is its deep expertise in large-scale storage technology. Building reliable, high-capacity storage solutions is not something competitors can easily replicate overnight. The storage industry requires years of engineering expertise, manufacturing capabilities, customer relationships, and technological development. These barriers create a level of protection around established industry leaders. Another advantage comes from customer relationships. Large cloud providers do not casually switch critical infrastructure suppliers. Storage products are integrated into complex systems that require reliability, consistency, and performance. Once a company establishes itself as a trusted provider, those relationships can become very valuable over time. This creates a degree of stickiness within the business, and in investing, sticky businesses are often attractive businesses. The more difficult it becomes for customers to switch providers, the stronger a company's competitive position may be. One thing I personally find fascinating about Seagate is how often investors underestimate infrastructure companies. People love talking about the newest AI application or the latest breakthrough software, but history repeatedly shows that infrastructure providers often capture tremendous value during technological revolutions. Think about it this way. During a gold rush, many fortunes are made by selling the tools needed to find gold. AI may ultimately follow a similar pattern. The companies enabling data storage, transportation, and processing could become some of the biggest beneficiaries of long-term AI adoption. Seagate sits squarely within that category. The company may not generate the same media attention as some AI-focused businesses, but its products remain critical to the functioning of modern digital infrastructure. As AI systems continue scaling globally, the amount of information requiring storage will likely continue increasing. That creates a favorable backdrop for Seagate's long-term growth story. Of course, investors should remain aware of potential risks. Technology spending can fluctuate, storage markets can experience cycles, competition remains present, and economic slowdowns can impact customer purchasing decisions. Those realities apply to virtually every technology company. However, when evaluating long-term opportunities, it is important to focus on durable trends. And one trend seems increasingly difficult to ignore. The world is producing more data. Artificial intelligence is accelerating that growth, and someone has to store all of it. For that reason, Seagate remains one of the most interesting ways investors can gain exposure to the data storage side of the AI revolution. As AI infrastructure spending continues expanding, Seagate appears well-positioned to benefit from the growing demand for high-capacity, cost-effective storage solutions. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now, when we look across the two companies discussed in this video, something becomes clear. Each company offers exposure to a different aspect of the AI storage opportunity. SanDisk benefits from growing demand for NAND flash memory and enterprise SSD solutions. Seagate benefits from rising demand for high-capacity hard disk drives used by hyperscale cloud providers. Different approaches, different strengths, but both tied to the same powerful theme, the explosion of data. And that may be one of the most important investment trends of the coming decade. Many investors are focused entirely on AI software companies. Others are chasing semiconductor stocks. Those areas certainly have potential, but storage remains one of the foundational pillars supporting the entire AI ecosystem. Without storage, AI cannot scale. Without storage, AI cannot learn. Without storage, AI cannot function effectively. That is why memory and storage companies deserve serious consideration from investors looking for AI-related opportunities. Will both stocks outperform? Nobody knows. The future is never guaranteed, but what we do know is that AI continues generating unprecedented demand for data infrastructure, and these companies are positioned directly in the middle of that trend. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Now I want to hear from you. Which company do you believe has the strongest long-term competitive advantage in the AI storage market? SanDisk or Seagate? Let me know in the comments and tell me which stock you think has the greatest potential over the next 5 to 10 years. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.